gross profit. For us, gross profit was the most important measure we ever looked at in Dynamic. It was the number one measure. Gross profit is revenue minus direct cost of goods sold, direct cost of sales. Not salsa. Right, that's what gross profit is. So if I have taken a project and I've invoiced 100K, that's my revenue, right? And then over here, I've spent, I don't know, 50 grand on labor. So subbies, apprentices, carpenters that are employed by me, laborers, anyone who is actually a person, I spent $50,000 total cost. Now what I've paid them, that's the bottom of the form, well, not the bottom of the formula for our hourly rate calculator, because by the bottom we've added in overheads, profit and contingency. That is just the cost of those people, including their leave loadings, their superannuation, etc. Minus materials. And I might have spent $20,000 on materials, right? That's 70,000 between the two. So my direct cost of goods or cost of sales is $70,000. This is $100,000 is my revenue. That leaves me with $30,000 gross profit. I've made that much money. That's my gross profit. We were always targeting 30% gross profit. Anything below 27%, and we had a problem, right? And yet, as a company, we were targeting 15% net profit, bottom line profit, and we were walking away at the end of most years with somewhere between 7 and 8. And to get there, we needed to achieve 27 to 30% gross profit. So what does that 30,000 cover? I'll switch back here and I'll show you. So it covers everything else. So all of these are our overheads or fixed costs. Let me zoom in so you can see them a bit. So insurances, bookkeeping, bank charges, cleaning, maintenance, computers, consulting, directors or insurances, utilities, fines and penalties, my guard dogs, of course, home office rent, any marketing, office equipment, fuel, postage, printing, rent on the office, safety and medical amenities, staff training, subscriptions. So, Xero subscription, for example, phones, tolls, more insurances, uniforms, vehicle repairs. So we've also got our fixed labor, which is our admin and managers. So if you're the only admin and manager, and for now it may be that you're only spending half your time offsite, in which case half of your wage should go into here and half of it should go into the on-site category. So what is the percentage of people, the percentage of wages that you pay when people are not producing any work that you can bill for, right? All of these are your fixed expenses and they're just a cost of doing business. You can't get away from them. So all of those are what you can pay for out of your 30K. Your gross profit has to cover your overheads, your managers and admin. And if there's anything left, your actual profit, which, just to be confusing, is called net profit. Or it's the bottom line. So your net profit is all the way down to the bottom line of, I only put one T in it. I know I've always drawn with two T's, but there you go. It's the bottom line of a P&L, which is where the team tell me the bottom line comes from. So I'm going to map that out again here because it's confusing. We have income or revenue. As the first line on our P&L, right? Usually we'll then put a nice little line across there. We then take out our, I'll call it direct costs. Direct costs, cost of sales, also known as variable costs or cost of goods sold. Right? They go over here. You subtract one from the other to give you your gross profit. So let's put in figures again. So that was $100,000. In this case, it was $70,000. Therefore, my gross profit is $30,000. And really what we cared about was our percentage. That's a 30% gross profit, right? Then we would have overheads, which include technically managers. Well, we broke them into a separate one, but let's just call it overheads for now. And let's assume for a second that that's $20,000. Then we would get our net profit. $10,000 or 10%. That is a P&L in a nutshell. Those are the segments of your profit and loss statement. Your income, revenue, your direct cost of sales, variable costs, which gives you gross profit, then your overheads, and then your net profit.